The conversation that we're going to have today is going to first talk about passive investing, but within that we're going to focus about index funds as well as ETFs. How do you differentiate between the two? What do you select? What is more efficient? And then we'll also talk about asset allocation strategy, specifically regarding equity and whether or not you should follow a core and satellite approach to constructing your equity portfolio. My guest today is Rushabh Desai, who is the founder of Rupee with Rushabh Investment Services. Thank you so much, Rushabh, for joining in. And like I mentioned, the first conversation is going to be on index funds versus ETFs. We've had conversations in the recent past about passive and the fact that it's growing very quickly. But let's talk about the pros and cons of each of these. Let's start with ETFs. How do you differentiate between the two, and what are the pros associated with ETFs?
Alex, thank you so much for having me on your show. So let's start with the advantages that ETFs provide. There are mainly three advantages in my view. Since these products don't require active call taking intervention from the fund manager, ETFs are super low cost products in terms of expense ratio amongst other mutual funds. Their expense ratio can, are as low as 0.05%. Number two, since they are traded on the stock exchanges, they are very beneficial for intraday and short-term traders who want to take intraday and short-term upward price momentum benefits. Also, ETFs are more popular amongst large and institutional investors. As they usually trade in high volumes, they can directly approach the AMC for bulk units and can avoid brokerage and impact costs.
Okay, so there are some clear advantages associated with ETFs, and we'll get to index funds in just a bit, but there are not necessarily everything good about ETFs also. I would assume that there are some drawbacks. For example, it needs to be deep enough for it to be something that you can consider. So what are the overall drawbacks that you would associate with ETFs?
Right, absolutely. So there are two main drawbacks of an ETF. One is that because they are traded, there can be a price dislocation between the actual price of the underlying benchmark and the traded price of the ETFs. So what I mean is that ETFs can trade at a premium, and investors who do not understand this can bear impact costs and opportunity losses. This is number one. Number two is that Indian ETF market is not yet fully developed. So there can be immense liquidity issues. So if someone wants to sell their product on the stock exchange, there can be lack of buyers as well. That is the second major drawback. Also, I would like to mention is that ETFs will require a demat account, and one would need to register with a broker to trade, which can be a drawback in my view as well.
Okay, but having said that, there are also a large number of people that are now joining the fold of the stock markets. In fact, with the number of demat accounts being opened up, I think quite a large number of people can access ETFs. Having said that, what you mentioned I think makes a lot of sense, in that there could be a dislocation if there are no buyers when you want to sell. So you might have to sell at a loss or buy at a premium if you really want to buy and there are no sellers. All right, let's talk about index funds though. And the first question, of course, has to do with the difference between the two, because they essentially track the same indices, right, Rushabh? So how do you differentiate between an index fund and an ETF?
So as you correctly mentioned, both of them track the underlying index. Index funds and ETF belong from the same family. So the only difference is that index funds can be easily bought and sold through the mutual fund house without requiring a demat account, and ETFs will require a broker and a demat account to trade. So this is the only difference I feel.
Okay, so let's talk about index funds in a little bit more detail then. What are the basic characteristics of an index fund? and what are the advantages associated with buying into index funds. And there are quite a few very popular ones that track the benchmark indices, for example, the Nifty 50 or the Sensex 30. I know that there's a UTI Nifty 50 index fund, as well as an HDFC Sensex index fund as well. Quite a few offerings out there. So what are the key advantages of having those?
Okay, for starters, as I mentioned earlier, index funds do not require a demat account and a broker to invest in them. That's number one. Number two, there is no liquidity issue, since the liquidity is taken care by the AMC, because you are buying and selling through the AMC, right? Number three, there is no price dislocation between the actual and the traded rate, because index funds are not traded on the exchanges. Thus, there is no impact cost, and the investors get the actual end of the day closing value of the underlying index. Also, compared to active funds, expense ratio of index funds are still dramatically lower. And lastly, also, I would like to mention index funds, are very convenient for investors who would like to do SIP, STP, SWP, which ETFs don't provide this facility. Some brokers may provide, a SIP kind of automated fashion way, but it's still going to be a tedious task and a manual process.
Okay. There are obviously disadvantages also with holding index funds, and I think tracking error is something that you have to bear in mind. Wouldn't that be one of the key disadvantages? And what others have you listed down?
Okay, so basically, I don't see much drawbacks in index funds. Yes, as you correctly said, tracking error, yes, because the index fund has to mimic the underlying benchmark in an absolute precise manner. So the lower the tracking error is the better the return one will generate in an index funds. So index funds are, as I mentioned, are low cost, much more convenient to track and execute in every way. Now, in comparison to ETFs, I would any day prefer index funds. I only recommend investors to venture into an ETF if it's a unique scheme and there is no index fund available for that particular ETFs. Now, coming to the active side, ETFs like index fund versus active funds, observing the high underperformance of many active funds, passive funds definitely do have an edge over many active funds and deserve a generous space in an investor's portfolio, especially in the large cap segment. Although I strongly believe that our fund managers have immense potential to generate alpha and outperform the index in the mid and small cap space. So alpha generation can be, a disadvantage what passive funds can face.
Okay. I do want to understand now, just to wrap everything together, Rishabh, and perhaps we can spend a little bit of time talking about how one should approach this. Is it right to say that if somebody wants a more systematic approach to investing over the long period of time, if they are using some aside into an index fund, that an index fund is the way to go? And maybe if there are specific offerings, and there is the advantage now of going into ETFs that look at underlying assets in the US, for example. Is that where you go for an ETF option?
Okay, so I'll answer this question, how to construct an passive kind of an equity portfolio. So today we have a wide range of passive funds in large, mid, small, sectorial, thematic, and international segments. So just like constructing any other equity portfolio, a passive portfolio should be based on one's goal, risk appetite, time horizon, and asset allocation. This should be the, what do you say? One should build a portfolio based on these four factors. Now, ideally, I would suggest investors to keep their passive core portfolio simple by sticking with the traditional market cap based strategies, like say in domestic side Nifty 50 index, and on the international, say like US side S&P 500. Now, as I said, that as there is still immense potential in our country to generate alpha mainly on the mid and small cap side, so I feel a combination of active and passive funds will work best, but having passive funds in one's portfolio will help mitigate and reduce the risk of major underperformance in one's portfolio. Now, coming to the international side, particularly for say like US, like developed markets, and also for developing sectors like electric vehicle segment, I would still bet on passive strategies rather than on active ones.
Understood. I actually want to talk about strategy in more detail. I think that we need to establish this whole concept of diversification, the concept of how do you construct an equity portfolio overall. I think, Rushabh, a lot of people that are entering the market tend to think that perhaps it's a good idea to stick to either only large caps or to invest only largely in index funds. They look at it as an either or option, but I think what you're trying to say is that you can have a good combination of both depending on your risk approach or your risk taking ability. We'll talk about this in more detail. We're slipping into a short break. Welcome back. You're watching The Money Show and we're speaking about equities. We spent a little while talking about passive investment strategies, how you should approach investing into passive equities, or rather through the passive investing strategy, either in index funds or in ETFs. And really, I think the conclusion was that if you are a long-term investor and you're looking to build a portfolio over a period of time, then index funds are essentially the way to go. We're speaking to Rushabh Desai. Rushabh, now I want to pose a question to you that I think a lot of our viewers will benefit from. If a potential investor is looking to build an equity portfolio from scratch, I think the question that arises is that there is a plethora of options available. So how should they go about constructing it? On the one hand, they have the ability to pick and choose the top large cap names, the likes of Reliance Industries, TCS, Infosys. These are frontline stocks that I think a lot of people will bet on for the long term. So they have that option. They have the option of going into an active strategy where they trust the mutual fund portfolio manager or the mutual fund manager to choose a stock that will outperform, and that's where your alpha generation came in. Or they could choose to have a passive strategy where they look to bet on the growth story of India. So how should one approach constructing an equity portfolio?
Okay, so if an investor is new, who does not understand equity markets, who just wants to build wealth over a long period of time, then sticking with passive funds, whether it is in large cap, Nifty 500, mid cap, small caps, in a little bit of a international exposure will work best. And I'm talking this from a 10-year, 15-year, 20-year perspective, right? There is no worry about underperformance. There is no worry that, which fund manager should I bet on, and all of that confusion completely goes away. But as I said earlier, that the constructing of one's portfolio should be clearly based on one's goals, risk appetite, time horizon, and asset allocation. So a combination of active and passive funds would ideally work best, but it really depends on purely on the investor's time horizon, risk appetite, how they will need to sit with their advisor and jot down a strategy. But I don't see any harm sticking with, say, for example, if someone is a senior citizen and something like, then I would suggest, like large cap, traditional Nifty 50 and Sensex plans, which just eases everything out. So this is how I would typically approach.
Understood. Now, it's said that perhaps one of the most important factors to bear in mind when you are constructing a portfolio, an investment portfolio, not just equity but across the board, is diversification. You should have different types of assets. You should have investments in equity. You should have fixed income. To a certain extent, people say that you should also have a little bit of gold. But specifically in equity, and I think you can apply that strategy to equity as well, how important is diversification? Because you have the ability now, Rushabh, to invest in international stocks, in international equity as well.
Correct. So in any portfolio, be it on the active side or the passive side, diversification is the key for delivering consistency in returns and for wealth creation. I mean, be it different market caps and sectorial companies and different markets around the world will have their own cycles of outperformance and underperformance. So having a little bit of diversification based on risk appetite, a little bit in large cap, mid cap, small cap, a little bit in gold, debt, and the asset allocation is the key for long-term wealth creation and consistency. So yes, in my view, rather than sticking to just one particular fund, it's always good to have a diversified portfolio.
Okay, now this is something I mentioned at the start, Rushabh, which is the core and satellite. There is a strategy that people have suggested to say that your core portfolio should ideally have passives, and there is an argument made towards the large cap passive options, especially because ordinarily in the past you've suggested an active approach to even that. But like you've mentioned, there has been underperformance by a wide number of active managers, especially on the large cap side. So would you say a core and satellite for that kicker, for that alpha generation, is a good approach to have?
Yes, absolutely. A lot of people don't understand, what falls into core and what funds fall into the satellite portfolio. So I'll just take you through this. So a core portfolio should be mainly for long-term growth, stability, and consistency. That is what a core portfolio should be of. On the other hand, a satellite portfolio is meant for taking tactical bets on cyclicals, value, thematic, and sectorial oriented funds. Now, core funds can consist of large caps, and in my view, even mid and small caps can be considered in this core bucket. Also, for your viewers, giant and large cap market cap based passive funds from developed international markets like US can be considered in one's portfolio. But I would still not bet on gold because gold is a very cyclical asset class. I would still not bet on gold as a core part in one's portfolio.
Understood. All right, I think we've more or less figured out how passives can be approached, as well as the construction broadly of an equity portfolio. And of course, over the course of the various editions of this show, we'll discuss this in a lot more detail. It's been an absolute pleasure speaking with you, Rushabh. Wish you, your family, as well as your colleagues and your team a very, very happy Diwali from everyone here at ET Now.
Thank you so much, Alex. Wishing you and your viewers Shubh Deepavali and Saal Mubarak.
All right, thank you so much. On that note, we've come to the end of this edition of The Money Show. It's been an absolute pleasure bringing it to you. Do stay tuned, lots more coming up in just a short while. This is ET Now.